Happy Friday. In fact, happy Good Friday. As we enter into this Easter weekend, I felt it necessary to do a quick video to put this past year, and especially first quarter of 2026, into perspective. Because let's face it, there has been no shortage of volatility or uncertainty. We've dealt with tariff tantrums, recession fears, government shutdowns, interest rate chaos, and Federal Reserve controversy, midnight snatch and grabs of foreign leaders, drug cartel interdiction and bombings, and that little thing that's going on right now called the war in Iran. I'm not here to try to predict a certain market outcome, but I do want to emphasize the fact that none of this is new. No matter how vigilant or proactive we are, playing the long game is the best bet. Don't let headlines, news commentators, that all-knowing coworker, and especially the ever-present social media and TikTok advisors out there influence your emotions and outcomes. Our country, economy, and market systems have overcome Great Depressions, world wars, presidential controversies and assassinations, multiple election cycles, financial meltdowns, housing market crashes, and countless bear markets, recessions, and other normal market corrections. I'll continue to offer weekly market updates with as unbiased points of view as I'm capable to help navigate through emerging trends and situations. But most important during these times of volatility is to understand that your personal risk tolerance and risk number and what it means. So my job is to provide you with solutions that have realistic expectations and investment returns that are aligned with your risk number and your comfort level. So that's why I've crafted a number of customized investment portfolios, each with different objectives and risk levels. If at any time you are unsure or uncomfortable with your current investment strategy, I implore you, schedule some time with me and we'll discuss. So looking at the website here, I want to point out some recent updates we've made that you might find informative, as it includes in-depth details about each of our unique dual defense strategies. So if you go ahead and navigate to the Canopy Financial Solutions homepage, you'll see the drop-down menus at the top. For a full overview, kind of the 30,000-foot view on my general investment philosophy and background on these dual defense styles of management, please check out the investment management tab here. And then also have some additional videos posted on our YouTube channel. So the primary focus right now is I want you to understand where we are, the current posture on the Canopy Custom Portfolios page. So we'll navigate here. So each of these, we scroll down here, we get to the dual defense tactical growth portfolios specifically. And, scrolling through the lineup here, you'll see that there are 4 distinct strategies, each with the primary objective of growth, just in varying levels of risk. So in short, we want these underlying investments to either appreciate in value or to apply a reinvested dividend towards total returns, or a combination of both. So you'll see the different current portfolios we have in effect are, zoom that out a little bit so I can show you. We have a conservative, a tax-aware growth portfolio. Again, the primary objective here is to grow it, but with less frequent trading that might trigger realized capital gains. A growth and income portfolio that combines those reinvested dividends with appreciation to give you kind of a sweet spot that might suit your risk tolerance a little better than just the full out growth opportunities portfolio. So they're currently listed in order of lowest risk to highest risk, which naturally corresponds to the expected targeted annual investment returns you might get from these different portfolios. So to see even more details on the current holdings and analytics, probably more information than you would ever care to read about, I want you to go ahead and click on this button. Each portfolio has its own set of portfolio analytics. Just a key thing here, I'll let you go ahead and read through this on your own time, but we have two obvious big numbers here that stick out: the risk number and the CAGR, or compounded annual growth rate. So the CAGR number represents the average annual return over the course of a 20-year period. So when you compare this to the S&P 500, we can see that even this conservative portfolio, it achieved alpha or outperformance over its benchmark. It's important to understand that CAGR represents smoothed average over time. There absolutely will be periods and years that our strategies will return less than the stated CAGR, and sometimes even less than the benchmark. That's normal. Play the long game. I really encourage you to read more so that you understand where our current investment posture is as a whole and as a firm, and where your investment profile options lie. So that's all for now. Stay tuned for normal weekly updates, and please don't ever hesitate to schedule time with me to better understand, your household portfolio posture and what your other investment options are. Have a blessed Easter holiday. God bless our troops that are currently in harm's way, and above all, God bless America and her strength to triumph over evil.